Hello, everyone. Today, we're going to delve into the subject of bonds. Specifically, we'll examine how bonds can be utilized to hedge risk within a portfolio. To do this, we'll focus on notable bond ETFs such as AGG, BND, and TLT, and discuss their significance in investment strategy. AGG and BND, TLT are ETFs that reflect the diversity of the U.S. bond market, offering more stable investment options compared to stocks. TLT, which invests in long-term U.S. Treasury bonds, tends to move inversely to the stock market. TLT could be a suitable choice for investors looking to manage risk over the long term alongside stock investments. U.S. bonds are debt certificates issued by the U.S. government, companies, and local governments to raise funds. These bonds are structured to pay interest to investors for a set period of time and return the principal at maturity. U.S. government bonds are classified into three main categories. 1. Short-term government securities, known as T-bills, have a maturity of less than 1 year. They are issued at a discount and pay the principal amount at maturity without regular interest payments. 2. T-notes are medium-term bonds with maturities ranging from 2 to 10 years. They pay interest regularly. 3. T-bonds are long-term bonds with a maturity period of 20 to 30 years and also make regular interest payments. The biggest attraction of U.S. bonds lies in their stability. In particular, U.S. government bonds are considered one of the safest investments in the world. However, yields can be relatively low as they are stable, and bond prices can be affected by fluctuations in interest rates in the market. There is something you need to know about interest rates and bond prices. Contrary to popular belief, when interest rates go up, bond prices go down. If interest rates go down, bond prices go up. This correlation is why bond investment feels difficult. Let's briefly find out why it's moving in the opposite direction. The table above shows the relationship between interest rates and earnings that we commonly know. Consider bank deposits. For example, if I had $10,000 and the interest rate was 3%, the year's earnings would be $300. So my total deposit is $10,300. If the interest rate is 4%, it's $10,400. If it's 5%, it's $10,500. It's simple to understand, right? But the correlation between the value of bonds and interest rates has a slightly different principle. Let's take a closer look at this in the following table. As I explained earlier, bonds are structured to return principal when maturity arrives. So, buying a 1-year bond means that the amount you're going to get in a year is fixed at $10,000. For this reason, bonds are called fixed income, because the amount you will receive is fixed. So the price of the bonds we buy means how much we pay now for the $10,000 that we'll get back in a year. Interest rates play a role in discounting the price when purchasing bonds. If the interest rate is 3%, we're buying the bond for $9,700. If it's 4%, it's $9,600. 5% is $9,500. If it's 6%, that's $9,400. The higher the interest rate, the lower the price of the bonds we buy today. It's confusing, right? Don't get complicated, and it's easy to remember that if interest rates go up, bond prices go down, and if interest rates go down, bond prices go up. Because we're not running bond prices with complicated calculations, we're trying to buy related ETFs to pursue profits and diversify the risk of our portfolio. Let's take a look at AGG, BND, and TLT, which are representative bond ETFs. AGG and BND are ETFs that offer a relatively low risk level while investing in a diverse range of bonds across the U.S. bond market. These can be good options for investors looking for broad exposure to the bond market. TLT is an ETF that focuses on U.S. long-term treasuries, aiming for higher yields but comes with a medium risk level. It is more sensitive to interest rate changes, which can lead to significant price fluctuations based on market conditions. The AGG ETF, operated by BlackRock, is a comprehensive bond market ETF that provides comprehensive market exposure across a variety of bonds issued within the United States. The ETF aims to invest in various types of bonds, including U.S. government bonds, corporate bonds, mortgage securities, and local government bonds, preserving capital with stable returns for investors. As you can see in the graph, this ETF primarily invests in a variety of U.S. issued bonds, such as government bonds, corporate bonds, mortgage-backed securities, and municipal bonds. It is notable that approximately 42% of the portfolio is comprised of treasury bonds, reflecting a structure that prioritizes stability. It is also noticeable that investments are made in a diverse range of bonds, from short to medium and long-term maturities. As such, AGG primarily focuses on stable investments and is a suitable option for investors looking to minimize exposure to market volatility. Especially during times of economic uncertainty or high volatility, bond investments can provide relative stability compared to other asset classes, such as stocks. Investors can easily access a wide array of the U.S. bond market through AGG, allowing them to manage portfolio risks and aim for long-term asset growth. This ETF, managed by Vanguard, is similar to the previously mentioned AGG, in that it invests in a variety of U.S. bonds to provide extensive market exposure as a comprehensive bond market ETF. Its expense ratio is 0.03%. Looking at the composition of BND's portfolio, about 67% are made up of bonds issued by the U.S. government. By type, you can see that about 50% have bonds issued by Treasury agency. Like AGG, we mainly invest in government-issued bonds, so we have very stable investments. Bonds in possession are widely distributed from short to long term. Both BND and AGG are ETFs that invest in various bond markets in the United States. These two ETFs aim to pursue stable returns by offering investors a diverse portfolio of bonds. As you can see from the graph, there is little difference between BND and AGG, so there is no problem with choosing either one. TLT is an ETF managed by BlackRock such as AGG that invests heavily in long-term U.S. government bonds over 20 years. The ETF is primarily invested in long-term government bonds issued by the U.S. Treasury, aiming for stable interest returns and capital preservation for investors. As previously described, TLT is primarily investing in long-term government bonds issued by the U.S. Treasury. If you analyze the investment distribution by period, you can see that it primarily focuses on bonds with maturities of over 20 years. As previously explained, bonds tend to move in the opposite direction of typical stocks or ETFs. Let's take a closer look. The following chart compares the S&P 500 with TLT and AGG. In this chart, TLT is represented by a yellow line, while the S&P 500 is depicted with a green line. The S&P 500 has seen significant growth recently, but it experienced major declines during the 2008 Lehman shock and the 2020 COVID-19 pandemic. On the other hand, TLT, which focuses on long-term U.S. Treasury bonds, tends to move inversely to the S&P 500. AGG showed little movement during both the 2008 Lehman shock and the 2020 COVID-19 pandemic. This indicates that AGG, investing in a broader bond market, tends to maintain stability even in the face of specific economic shocks. Therefore, by combining stocks or ETFs with bonds in an appropriate ratio, there's potential to effectively hedge the risks in a portfolio. Finally, let's explore the outcome of combining the S&P 500 and TLT in a portfolio. The blue graph shows the performance of mixing the S&P 500 and TLT in a 7:3 ratio. Conversely, the red graph represents the performance of the S&P 500 alone. Particularly noteworthy is the decline in 2020 due to the pandemic. The red S&P 500 index graph indicates a maximum drop of 19.63%. In contrast, the portfolio composed of a 7:3 ratio experienced a mere 9.13% decrease. As previously mentioned, bonds are inherently stable assets and tend to exhibit smaller declines compared to stocks. While total returns might be slightly lower, incorporating bonds can enhance your portfolio's stability and mitigate risks. AGG and BND, TLT are ETFs that reflect the diversity of the U.S. bond market, offering more stable investment options compared to stocks. TLT, which invests in long-term U.S. Treasury bonds, tends to move inversely to the stock market. TLT could be a suitable choice for investors looking to manage risk over the long term alongside stock investments. Thank you for watching until the end. I hope this video helps you, and wish you all successful investments.